Good day, everybody. This is Jim Kinney, and this is the weekly market update for OptionProfessor.com. And basically, this will be for October 5, 2018. As always, I do remind you that past performance is not necessarily indicative of future results. And short-term trading, option trading, and that type of thing does involve risk and is not right for everybody. So do consult with your financial advisor, financial consultant, or your good common sense and your clearing firm to find out what, if anything, is suitable for yourself. Today, I'm giving you my views and my opinions. We've seen the market roll over here this week at the end of the week, and I was on a broadcast earlier in the week, and I was warning people that the transportation average and the Russell were rolling over on Monday and Tuesday. And so I was warning people that that could be a precursor to the bigger markets of the Dow, the S&P, and the NASDAQ rolling over, because the transports um, had led, and the Russell had led the advance. And so when your leaders roll over to the downside, that is cause for concern. I also warned people that if the VIX did break above the 13 level, that an acceleration to the downside could also occur. So that also was fairly accurate, because you'll see here in the last 10 days, let's just go I'll put up a 10-day graph here so you can see some things. And the VIX, as you can see, once we got above 13, see that 13 area? Boom, spiked up to almost 16, and now it came back down, but now it's back on the bicycle again. What's it going down? What's the reasoning behind it? I think it's as simple as this. The stock market is priced for a certain interest rate on the 10-year note, and the 10-year note busted. Now let's go give you a chart about the 10-year note, meaning the Treasury 10-year, what it pays in interest, spiked up. And I think it got people very concerned, because I don't think the stock market has priced in a 4% 10-year note. And as you can see here, this is a 2-week graph, right? Now look at those interest rates spiking up, which I told you that they might do if it broke above 310. You see, when we broke above 310, what happened? Bam, up to 322 in how long? Not very long. So you got a big move up there, right? And that gets people going, you know what? The 10-year could go to 4 or 4.5%, which some people are talking about. Are we pricing stocks correctly if the 10-year is going to 4 or 4.5%? And the answer this week so far has been no. Now, don't forget, you do have earnings coming up, which could bail this drop out. So right now we're talking about a dip. And a dip means that it could be a buying opportunity at some point. But if these earnings start disappointing, on top of the concerns about the 10-year note, on top of the concerns about wage inflation, this Amazon hike in the minimum wage could very well put pressure on people like Walmart and Target and others to increase wages. Don't forget, you're at 2 and 3% on these long-term securities. That's not factoring in a whole bunch of inflation, right? And wage inflation can sometimes turn into price inflation. The other thing that's concerning, and one of the economists from Citigroup was saying that the tariffs, have been some of the increases in prices have been absorbed by the companies because of the tax cut. But next year, in quarter number 1 of 2019, companies may very well try to raise prices. And some people are already starting to raise prices now in the fourth quarter. If they see that people are getting away with raising prices, we may see price raising across the board in Q1. If you take wage inflation and you take price inflation and you look at a treasury with 3% handles on it, you're talking about something that might not be correctly priced. And that's why they're starting to break out on the upside, and they have the potential of accelerating to the upside. Citigroup's president, Jamie Dimon, has thrown the 4% number around, and even higher potential. And Paul Tudor Jones has thrown around a 4.5% type of handle on the treasuries if they were priced where current economic situations would warrant. So there are some fairly well-heeled people that have thrown around higher numbers on the 10-year note. And if we are going to those numbers, it's possible some of the people in the stock market are not that confident that the prices of stocks may be reflecting that. And so this could be the beginning of nothing. It could be a pullback and then we go flying up again, or it could be the beginning of something more severe, since obviously complacency and market bullishness are pretty darn high right now. And to find people that think there's going to be a 10% correction or more in the stock market, I think is very, very far and few between. Having done this for decades, that type of sentiment I don't think is particularly constructive. What is constructive, though, is the repat money being buying back their own stocks and the other situations such as the earnings. And these are very positive undercurrents of the market. And they're even talking about, tax cut 2.0. Now, that's all the stuff that is the tailwind, right? Don't forget also the Fed chairman, Powell, did say that he was concerned that the U.S. government is on a unsustainable course with their fiscal policy. And I think what he's talking about here is that the gross amount paid by the U.S. in interest in fiscal 2018 was $523 billion. Now, that's with lower interest rates. If you got higher interest rates, that number could easily rise. So we had $523 billion on U.S. government paid interest, and that is the highest interest amount ever, more than the prior 12 months. So it's increasing, and it's at a record level. And with widening deficits and higher interest rates, that is a cloud that nobody has really factored in that much. I think the bond market is starting to factor it in. And there is a gentleman who is on, or going to be on, Wealth Track with Consuelo Mack this week, named Richard Bernstein, who believes that the bond market is in a precarious condition because of the issuance of tremendous amounts of debt. Corporate, sovereign, municipal, you name it, right? Real estate. And obviously, when you change the calibration on interest rates, those debt markets may be upset. And a lot of money are in these ETFs. Now, if people start selling out ETF bond funds or bond ETFs en masse, which we've seen in the past, where people hit the sell button, the panic button, whatever button you want to call it, and they all want to get out or in at the same time, the order imbalance can be tremendous. And again, when you sell your ETF, they've got to sell those stuff because they may not have enough in reserves for redemption. We call it a redemption run. So there are risks on the horizon, but we cannot deny that the moving averages on the S&P are still rising. Let's take a look at the S&P. And you can see the S&P today is down 13. The 200-day moving average is at 2875 area. Okay. And this is the last 10 days. So you can see the bloom has definitely come off the rose. Tremendous, right? Nothing tremendous, but certainly it is the blooms come off the rose. It looks like 2910 is a pretty big area if you're a chartist. So if we can hold these lows and then take out 2910, I think you'd be back on the bicycle, or at least try to fill in that gap between 2920 and 2925. But if we do take out the lows of 2885, ballpark figure, something like that, then of course that 2875 would be your next number, and then 2800 would be your next number. So there's a couple of lines in the sand here. 2800 is an important area. Last month's low was 2791, I believe. And I'll just verify that for you real quick. On the S&P, last month's low, actually last month's low, September, was 2865. So, August low, 2791. So there are your 2865, last month's low, 2875, your 50-day moving average. That should be some support if we're in still a good situation. And then after that, you're looking at 2791, 2800, which was the lows of August. So those are some lines in the sand. I've been suggesting to people to, and I've been doing this quite a bit, Amazon when it was at 2050, and recently on the S&P, I've been suggesting people investigate how the collars work, where you combine a call right and a put buy together. Again, that is a very good defensive move that puts parameters around your equity so you don't just sit there watching Rome burn. Also, just a married put that's out of the money cheap at least puts a parameter on your equity. Now, if you're not sure about how that all works, at the end of the broadcast, you can email me at optionprofessor@gmail.com. That's OptionProfessor@gmail.com. And then you could let me know when's a good time for us to coordinate a conversation and go through some of these things with you so you're more knowledgeable, and then you can make your own decision on what you want to do. All right. So anyway, that's the story here. We're rolling over. Let's just take it a couple of other indices here, because I got concerned when the transport broke under 11.5. Let me show you why that is. And again, this is the last 10 days. So this is the last 2 weeks of trading. See, when we broke under, well, you can't see here, but you can see that 10.5 area. The high on it was 11.623. You see the high right there, where the cursor is, 11. Okay, so it was up there, and then it had some support at around 10,500. Can you see the high 2 weeks ago, about 11,520? Then you see the high at 11,490, and then it couldn't get through that. So once it broke under that 11.5, can you see it's been trading underneath that, and it's down another 60 today. So what's my point? My point is if it gets back above 11,310, that would be constructive. And if it got back above 11.4, it would be constructive. And right now it's on the defensive. Okay, but it's still obviously way up from its 52-week low, 94.20. That also puts into play how far we've come. In the last 52 weeks, we've been as low as 94.20, and we are as high as 11.6. That's 20%. That's a big gain for a year. And the transport certainly have had it. But again, the bloom has come off the rose a little bit for those guys as well. Let's look at your Russell. Your Russell, again, down 9 today. And again, once that broke under 1,700, I became concerned. You see the high was 1742, and look when it got under 1,700, how it kind of accelerated to the downside. You see 1,700 had some problems there, had some support, and then once it got under 1,700, it's been on the defensive ever since. It did make lower lows today, so obviously that's still on the defensive in a bigger way. But again, huge move this year, 52-week from 1,400 to 1,700. That's 300 points. There's your 20% up from the low. Okay, so, these things have had big runs. And now the interest rate environment is changing a bit. And now the deficits are changing a bit. And there are other factors coming into play. And wages are increasing a bit. And so we have to keep an eye on, the trees don't grow to the sky. And that's why defensive strategies from sometimes like covered call riding, collars, and married puts are not a terrible thing to consider. Let's look at some stocks that have been in the news. Tesla, although I don't know why it's always in the news, but I guess the guy's always talking on Twitter or somewhere. Now, that stock, obviously in the last 10 days, it had a rebound very strongly after they settled with the SEC. But after you settle, probably not a good idea to badmouth them, and that's probably why it came right back down again. So anyway, he made the settlement with the SEC, and you go from 260 to 310. Then he goes on Twitter and starts making fun of them or whatever he was trying to do. Lord only knows. And now you're back in the soup. Okay, you also filled in that gap. So now you're down, filled in the gap. You got another gap there at 280. And if you're trading this stock, obviously when everyone is selling has been the time to buy. When everyone's buying has been the time to sell. Whether that strategy will continue or not, Lord only knows. But that seems to be somewhat effective in the last week or so. Okay, another stock that got a big jump is General Electric. And General Electric is at 13, and look what it's done in the last couple of weeks. Okay, 25 above 13. I had suggested to people, if you think General Electric is on the move, they did replace their CEO. The guy they brought in is supposed to be pretty sharp. So if you're betting on General Electric, you're betting on a turnaround because of this new guy. Okay. Now, could it take some time? Of course it could. So I was saying to people they could investigate the General Electric long-term puts out in 2020. and maybe go with a strike in the 13 area and try to play a buck or buck and a half for that thing. Well, that means you have a fixed limited risk of $1.50, whatever you pay for the premium. And that's the total cost. That's your total risk. And then you sit tight and see if this guy's got what it's got. This stock came down from 20. So in my view, let's go take a look at the longer term graph. My opinion is that if you want to take a bet on these people, that the possibility of going back to 20 if things really turned around is not off the table. And if it did that, obviously, call strikes in the area. That's the last 6 months. Let me go back before that. I'll go back the last year and see what it looks like here. Okay. And you can see from the last year, it did bust down from the 20 area. So since it busted down from the 20 area, I'm thinking along the lines that if this guy really turned things around, it could have a pop, not unlike Macy's. You know, Macy's was down there out of luck. All of a sudden, it made a turn and it went up quite a bit. And you know, like I say, if this guy can really turn things around, get this thing to where the company's profitable, then obviously you could be getting a situation where it could get a pop. Look at that dividend yield, 364. At least you're getting, if you buy the stock, at least you're getting paid some money to watch the stock vacillate or wherever it's going to do. The other markets that I've been looking at here are the oils. And let's take a look at Anadarko, which has been doing pretty good. We've been looking at that thing since it was in the low 60s. And as you can see a bit, and looks like it's got good support at 65, the former highs there, and of course at 60. And the moving averages are under the price in the 65 area. So as long as we're trading above 65, it doesn't look like a bad thing there. Let's take a look at Chevron. Big company. And Chevron is trying to, you know, ever since it hit 100, it filled that gap at 105 and went way past it. So right around 105 would probably own, and it pays 335 as a dividend yield. And if it can get above 110, I think that would be very, very constructive. So up here, you might want to see if it can break that 110 or try to buy a pullback a little bit. But Chevron does look like it is also trying to turn to the upside. And then one of the leaders is ConocoPhillips. And in ConocoPhillips, you are looking at a company that has had a pretty good run up, but it continues to look pretty good. And as you can see here, it has gone, it's only about a point or so off its high, and it looks like it's also uptrending. It had a pretty big volume deal there. So again, you know, number of ways to play these things. You can buy the stock and sell calls against it. You can buy the stock and you could do a collar, so you have upside potential, but you've got a downside floor. And you could also investigate call buying or bull call spreads. Or if you'd like to do put writing and you have the cash in your account and the wherewithal and the interest to actually buy the stock if it's put to you, there's a whole bunch of different approaches you can get into. So again, you know, investigate these things, and do feel free to email me at the end of the broadcast if you have any questions on this. Okay, let's go around the world, as I say, around the horn, and look at some of the other markets besides stocks. We went over the interest rate market, so you know that the 10-year has broken above 310, and it's in the 320s now, and it is being underpinned by the wage inflation and the potential for price hikes by these companies, and also the huge deficits that may be coming down the pike. That's the way the debt markets are kind of going right this second. And so obviously, you know, if you're in the bond market, you know, these are all my personal opinions. You know, keeping short term in your duration and rolling short term instruments seems to be the way to go, because we're in a rising interest rate environment. You know, you don't want to be caught way out there 30 years if these rates do go to 4 or 4.5% or wherever they want to go. If they do that, you certainly don't want to be stuck in a bunch of bonds. Now, don't forget, how many people bought bonds in the last 10 years under 2%? those people might at some point get very tired of owning something where the principal's going down and the yield they're getting stinks. So if they want to come out, if something instigates them to all come out, or not all come out, but you know what I mean, to start what they call a redemption run, that's problematic for the bond market. And again, if you total up how many people are owning bonds or long bonds underneath 2%, I bet you the number is pretty darn big. So there's a risk there in the bond market. You got to be careful there. Okay, and then again, one way of reducing your risk in bonds is cutting your duration back. The yield spread, the short-term rates are almost the same as long-term rates, so you're not giving up that much income. And obviously, with a short-term situation, it comes due pretty quick, right? So when it comes due pretty quick, you get your money back, providing you're buying an issuer who pays you back, like the U.S. Treasury. Okay, let's see what else is going on right now. The dollar. Okay, Dixie. It had rolled over from 97, and basically it was having a dip. Now it went to 94 and bounced back up to 96. Okay, so that's where you're at right now. Let's take a look at the moving averages to give us an idea where the trend is developing based on the moving averages. Okay, your 50-day moving average is 95.14, so it's above that, and your 200 days is 91, so it's above that. So the dollar is still in an uptrend. It was just having a dip. I had thought that the 115 level on the euro might be an area of support. It did break, went down to 113 and change, but then it recently went up to 117, 118. Now it's back in the soup a little bit. But if this dollar is to fail from this 95, 96 area and take out 90, then the euro would have significant potential next year. Why would that happen? With the yield differential between bunds and the U.S. Treasury, it's hard to really fathom. But if our budget deficit gets big enough and the printing press looks like it's going to have to get hit, then that may be something that would cause the dollar to fall. Certainly, what's underpinning it now is two major things. One is our interest rates are huge compared to Europe's. And number two is there's foreign nations like Brazil, Turkey, and Argentina who borrow in US dollars but get their monies in local currency, and local currency is not doing very well, so these people are scrambling to buy dollars because of some of their commitments. So there's a little bit of a dollar squeeze going on by countries such as that. Let's look at how emerging markets are doing, because that was touted so big in January, it was a joke. Look at January, 52. Everybody get into emerging markets, right? You heard it. And now look at emerging markets way down here at what? At 40. So they're under pressure because their local currencies are under pressure and because global growth has been slowing. So that was a very bad idea to get in at 52. Now down here, you got to sniff around to see if you see some kind of a turn maybe. But if the fundamentals don't change, it's kind of hard to change the price. And the downtrend on the moving averages are probably pretty pronounced. Obviously, getting above 44 would be very constructive for EEM, but that's not happening right now. So you keep an eye on it. Europe. I want to take a look at Europe real quick. This is the Europe spider, and you can see Europe. Everyone said to get in at 44. That was a bad idea in January, and here we are down here at 37. So that's on the defensive as well. Okay. All right. Now let's take a look at a couple of other things here. We looked at the dollar. We looked at interest rates. We looked at stocks. We looked at the oil. Now let's look at a couple of other things. The industrial. This is the Vanguard Industrial ETF. It right now it's had a nice run. It was in a nice uptrend. The moving averages are in the 145 area, which is exactly where the support should be. So if it can hold 145, I would stay constructive on the industrials. And there could be a rotation out of tech into these type of things if the economy is going to be strong in 2019. So if there's going to be a big move in the stock market, it could very well be in this type of a sector called the industrials. And if prices are going to rise and there's going to be some inflation, then of course the materials would be another sector to keep an eye on. But that's on the defensive right now, as you can see. They tried to break it out here. This is again the Vanguard materials out there. This is just an example. And you can see it tried to break out above 135 and then back in the tank to 130. Okay, so there you go. As far as a couple of sectors to keep an eye on, the industrials certainly still look a little bit stronger than the materials do. And then you've got retail. which I was telling people looked like it might be rolling over. Let's take a look at what retail looks like now. There you go. You see the ETF hit 52 and change, and now it's in the 48s. And some of the companies, such as Ross, which had gone on a very big move. Let's take a look at that. Looked like it could have a pullback, right? So, it went to 100 from 62. Isn't that a big move? Yes, it is. Now, the moving averages are clearly under the market. But again, a pullback is what I was talking about. And again, that's what it's had. So, retail is having a little bit of a turnaround here. You are going into the holiday season, though. And if the earnings start picking up big time next week, and then the holiday numbers are great. Again, this is Visa, another retail, spending type thing. It's come off its highs from 151 to 145. It's on the defensive. But again, it's still in an uptrend, and this is just a pullback so far. But again, if you start taking out 140, we may go from pullback to more of a significant correction. But it does look like the consumer, and they were saying consumer debt is getting a little bit on the rich side again, especially if you compare it to GDP. So the consumer has been really, really strong. But again, everybody takes a timeout at some point. And if these guys take a timeout, these stocks are pretty extended. So keep an eye on retail on a rollover type situation, or at least a pullback. Two markets real quick before I sign off. GLD. Well, I'm going to go with GDX, which is the miners of the gold stocks. They look like they've been trying to turn up. So take a look here, and you bottomed out there a little bit above 17. These are the gold miners, and you can see there could be a head and shoulders low being put in. So if you start breaking above 20 here, it should have some resistance at 21. So if it starts breaking above 19 and goes to 20, fills in that gap right there. Going up towards 21 is not off the cards. And if next year you're going to see big higher interest rates, you're going to see prices going up, you're going to see wages growing up, this thing is way out of favor and has been for a long time. And so this would be something I would keep an eye on, not to go nuts on, but for a small diversification, if this thing could make a turn here, I'd keep an eye on it. Because again, you are looking at something that's looking like it's trying to bottom down here. May not be, but that's the kind of shape that it starts in. If it's going to make a turn, keep an eye on that. And then according to Mr. Trump, I understand he's doing all these deals with Mexico and Canada, but unfortunately, he's not doing one with China, and that's the one the farmers need to hear about if the soybeans are going to sustain themselves. So let's take a look, and soybeans are at 859. Now, again, I've been a believer if we can get above this 860 area and stay here, that would be constructive. Okay, getting up above 9 would be very constructive. But can you see there's some 870 resistance here? If you can get above that, that would be helpful. Okay, again, if he can strike a deal with China, I think this thing would pop pretty well. But I don't know that they're in a rush to make a deal with anybody. So bottom line is that you can make the deals with everybody you want, but until you make it with the largest buyer of this stuff, getting these grains and helping the farmer, truly help the farmer, is probably maybe not going to happen that well. Let's take a look here, and just to close out. Let's see where we are in the S&P right now. Go here. And then we'll see what's going on. Okay, yeah, we're still here. And you can see if we break underneath this 28.75, what I told you, 28.65 was last week's low. And actually last month's low was 28.65. So you're not very far from last month's low. You blow that out, you're going to get a little bit more going on. And again, defensive tactics such as collars and married puts, are helpful. Of course, it's always best to buy your insurance when it's sunny out, not after Hurricane Florence hits, right? So you got to sometimes do preemptive action if you really want to get good prices on your hedge. With regards to the VIX, let's see if because if that gets above 20, then accelerating to the downside is more probable, but it's not above 20. It's really right around equilibrium. You see, I consider 15 about equilibrium. 20 I consider high, 10 I consider low. So right now you're right around equilibrium. If you break above 20, though, you have to be concerned about an acceleration to the downside of size. That's not happening now. But again, the numbers will be what they are. And you can't fight the tape and you can't fight the Fed, right? Okay, so I appreciate everybody being here today for this week's update. Again, this is Option Professor Weekly Market Update. I encourage you to send an email with any questions or anything on your mind. I'd be more than happy to communicate with you. It's optionprofessor@gmail.com, OptionProfessor@gmail.com. Until next Friday, I wish you all the best of trading and the best of luck. And thanks for tuning in. I'll be back with you next Friday.